How hard will bank revenues be hit in the months ahead? And will the Royal Commission put bank profits under pressure? Hello again, I'm Martin North, the Principal of Digital Finance Analytics. Given the range of issues already exposed by the Royal Commission into financial services and misconduct, including selling loans outside suitable criteria, fees from advice not given and other factors, we need to ask about the impact on the profitability of the banks and so their share prices. And all this in the context of higher funding costs, which are already hitting. A number of international investors and hedge funds have placed shorts on the major banks, signalling an expectation of further falls in share prices ahead. But the majors have already dropped by around 15% in the past year. And the recent RBA chart pack contains this picture on profitability. Bad and doubtful debts are very low, thanks to low interest rates. But that may change if rates would rise and liar loans are widespread. Now, there's no good data on the potential impact of this so far. So now it's important to remember the Productivity Commission recently called out that Australia's major banks have delivered substantial profits to their shareholders over and above many other sectors in the economy and in excess of banks in most other developed countries post the GFC. And a quick survey of the banks from the last year shows that the return on equity, which is a measure of absolute profitability, or ROE, ranged from 14.5% for CBA, 10.3% from NAB, 10.9% from ANZ, and Westpac was 13.3%, AMP was 11.5%. Now, comparing that with overseas, the US-based Wells Fargo, which happens to be a key Warren Buffett holding, by the way, was 11.5%. The Bank of America earned less than 6.8%, and Lloyds earned 4%. Barclays was negative 2.7%. In fact, among Western markets, only Canadian banks come close to our return on equities. For example, the Bank of Montreal was 11.3%, but then they have the same structural issues that we do. And data from news.com.au from 2016 shows the relative profit to GDP across several countries. Australia wins. That means that 2.9% of every $100 earned in Australia ends up as bank pre-tax profit, compared to the US and UK at $1.20 and 90 cents per cent, respectively. China is the highest after Australia at 2.8, Sweden 2.6, and Canada 2.3. The Australian Institute also pointed out that public money is being used to secure the banking sector. They said excessive profits provide a drag on the economy and hurt consumers who pay higher margins on bank products. The Reserve Bank found that the big four banks enjoy an implicit government subsidy worth up to $4 billion a year. Now, the Royal Commission revelations have the potential to impact the market value of the banks as reflected in their share prices, and also raises questions about the financial stability of the entire system in Australia. APRA in particular and the RBA have been perhaps overly focused on financial stability, as the recent Productivity Commission draft report highlighted. Regulators have focused on a quest for financial stability, prudential stability, since the global financial crisis, promoting the concept of an unquestionably strong financial system. The institutional responsibility in the financial system for supporting competition is loosely shared amongst APRA, the RBA, ASIC and ACCC. In a system where all have some responsibility, it's inevitable that, and particularly at the most important times, none are. Someone should be. And the Council of Financial Regulators should be more transparent, they said, and publish minutes of their deliberations. Under the current regulatory architecture, promoting competition requires a serious rethink about how the RBA, APRA and ASIC consider competition, and whether the Australian Competition and Consumer Commission, ACCC, is well placed to do more than it currently can for competition in the financial system. Over the next few days, we're going to try and assess the potential impact ahead from higher loss rates, lower fee income, potential fines and penalties. Then, of course, there will be the question of whether these additional costs and fines will be passed on to investors and shareholders or simply recovered from the current customer base by higher fees. we expect banks to start making provisions for the revenue hits ahead. ANZ, for example, has just said that their Royal Commission legal bill will be around $15 million, and CBA made a $200 million expense provision for expected costs relating to currently known regulatory compliance and remediation program costs, including the Financial Services Royal Commission. But to start the journey, let's look back at the relative performance of the bank share prices over the past year. The Westpac share price is 16.8% lower compared with a year ago. ANZ is down 16% over the same period. CBA has fallen 5.9% in the past 12 months, and NAB's share price dropped 14.2% over the same period. In comparison, the ASX 200 was up 0.25% over the past year. Among the regional banks, Bendigo Bank has fallen 16.6%. The Bank of Queensland has fallen 11.7% over the past year. And in contrast, Suncorp is up 0.74%, and Macquarie Group was up 19.5%, but of course they have more than half their business offshore now. So with that introduction, next time we're going to try and size the revenue hits ahead and think about what that may mean for the banks and their customers. But in a nutshell, we believe that they will come under sustained pressure as the bad behaviour translates into a financial hit. If you like what you've seen here today, please thumbs up the post and add a comment or a question. I read them all. If you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And I want to thank those who have already subscribed. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.